What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. Today, we're going to follow a similar format that we've been doing in the past. I jotted down a couple questions that people had. I wrote them down in my notebook. We're going to go through all of them on this episode today. And there was a couple of good ones, a couple of controversial ones. So I'm looking forward to it. I hope you are too. So without further ado, let's jump right on in because this week has been action packed. Let's discuss some of the stuff that we've been seeing. So, question number one: what was your read on Trump's statement Monday regarding Iran that caused markets to rally and oil to get hit? Was he lying? Because Iran obviously denied it right after. Yeah, this one definitely raised some eyebrows, and especially I think you add in the fact that it's been going around this week that somebody made a massive trade 10 minutes roughly prior to that announcement that Trump made. Somebody went long S&P futures and somebody went short simultaneously oil futures. So that whole event definitely caused some eyebrows to get raised, including my own. I'm not going to accuse Trump or the Trump administration of lying. I think this week has proved to all of us, given the headlines that we've seen, that the administration is truly trying to find an off ramp here and de escalate the situation that's currently going on in the Middle East. It's evidently not sustainable. Raised input prices, cost of gas going up for people at the pump. It's not a favorable situation for American constituents or really any constituents across the globe. So I think it's in the Trump administration's best interest to find an off ramp here. So whether there was a lie there or not, I think we also have to remember this was something that I read this week. Iran right now, since all of the top officials, the leaders of the country have basically been eliminated, Iran has been reduced now to being run by small factions within the country. So different geographical areas are being run by different groups. It's sort of like, I don't know what a good example would be, but let's say take California, for example, and instead of having like a governor of California, and you have maybe one person running the Sacramento area, you have another person running the Los Angeles area, you have somebody else running Northern Cal. Like there's everyone sort of is running their own little thing within California. I guess you could sort of compare it to that in Iran right now. There's no top leadership or overarching government. It's a bunch of small factions. So what I think may have happened here was that the Trump admin may have been speaking to an individual that they thought held whatever remaining power there is in that country, engaging in some sort of negotiation, trying to come to some sort of deal to end the war. But maybe another faction or the other factions in unison that weren't being spoken to were like, we don't know what's going on. We're denying that there was any talks. We're not engaging in any talks with the Trump administration. We want to retaliate on neighboring countries in the Middle East. So, there was so many headlines this week, back and forth, that talks were happening, that things were falling apart, that there was going to be a pause in bombing, that we're going to send troops over there. There was no shortage of headlines, and it was very confusing. Obviously, the market I've mentioned in one of my short form episodes on TikTok, YouTube, and on the Instagram, the market's reaction function to all of this stuff is starting to dwindle, and people are not buying good news and selling bad news as aggressively as they once were. But long story short, what are my takes on what happened on Monday? I think the administration is trying to de escalate the situation the best way that they know how. Whether talks were actually happening or not, I will never know for certain. But based on everything that I've read and all the headlines that have come across the tape this week, it feels like that's what the US would like to have happen. I can't say the same in Iran. I don't know if the leaders of these various different factions want to come to the table quite yet, unless Trump and his administration are ready to agree to the five terms that Iran set out, I think, on Wednesday. Yeah, I believe it was Wednesday. So let's move on to question number two. What are your opinions on prediction markets, and do you have any thoughts on Kalshi and Fidelity? Comment on sports betting stuff going through Congress. Okay, I think when they mentioned Fidelity and Kalshi, they're talking about that deal. That wasn't a deal, but I guess Kalshi came out and said, I read about this briefly. Kalshi came out and said that Fidelity is now going to manage the back end, sort of the plumbing of their platform. So if you think, I'm trying to use an example. So everyone can understand. If you place a trade on your broker, whether it's Thinkorswim or Wealthsimple, behind putting that trade in, somebody needs to clear the trade, make sure it settles. Like there's a bunch of stuff that goes on behind the scenes when you transact in the marketplace or place an order. Excuse me. Um, and Fidelity now managing all of that back end plumbing for Kalshi sort of opens the door for institutional investors to now transact on Kalshi. And I think it's a great thing for the prediction markets because historically, I mean, these things are brand new basically still. They've only been around for the last few years. But in the last few years, I think the biggest issue with prediction markets like Polymarket, Kalshi, various others has been people don't really trust, where their money is being held or are they going to get paid out. So this is sort of a vote of confidence, kind of, when you have a company like Fidelity who's been in this business for so long come in and say, hey, we're going to do all this back end for you guys and have this little partnership, so to speak. I think that really legitimizes the marketplace, and you probably start to see Polymarket and some of the other big platforms for prediction markets and betting, et cetera, start to do the same thing. Now, what do I think about prediction markets? I think they're a great thing. I do see there being an application in finance for hedging risks and being used to better carry out investment strategies or trading strategies. I think there's a lot of potential there for it to be used widely in finance. Now, where I start to have an issue is I think some of these companies, and I won't go into too much detail about it, but I think some of these companies are using their power and using their mystique and allure to draw in retail investors who, in a similar fashion, got drawn into Robinhood because they created such a fun looking app that was almost like gambling, where in reality it should be about, saving money, investing in your 401k, starting to build this nest egg. Like that's what investing and trading is about. But people have sort of, I shouldn't say people, but bad players in the space have sort of perverted that whole idea to try and win customers' deposits. And so they've made these fun apps that look sort of like, DraftKings or Bet365. And so now when you go into your Robinhood app or you go onto your favorite prediction market and you can see that, you can buy Apple stock, but at the same time you can bet on this Sunday's football game, you're sort of blurring the lines between traditional investing and trading and gambling. And that's where I don't really like the idea of prediction markets. If you can distinctly offer one and the other and you're the same company, that's fine, two different apps. But I think the way that the lines are being blurred, I've used that term now twice, but I just can't think of a better term. That's truly what it is. You're blurring the lines for people who maybe don't know better or who haven't been doing this professionally. And they might be, I guess, for lack of better terms, getting taken advantage of. And that sort of leads me into my next answer. I sort of already answered it by saying all of that. The stuff that's going through Congress right now, where they're thinking of disconnecting sports prediction markets and sports betting from apps like Kalshi and Polymarket, not being able to offer them on the same platform that people are able to trade. I think that's the right thing to do. There's a time and a place to gamble. It's no different than, if you have a budget and you want to go spend some time with your friends at the bar every second Friday and you spend $100 at the bar, that's your going out having fun budget. If you have that same budget for gambling because you really pay attention to the New York Knicks or your favorite soccer team and you want to place a bet on the game this weekend, that's completely fine. There is a time and a place to gamble and have some fun for sure. But when it comes to investing your hard-earned money and trying to grow it for the future and you have some financial goals, I think offering all those things under the same umbrella is not a great idea, and it puts the consumer at a lot of risk, in my opinion. If you can disconnect the two, still have a 401k on these apps, still do what you're supposed to do, and be responsible with your money, and also place bets with your pre-budgeted amounts that you're willing to risk on gambling, that's great. But a lot of people don't have that self-control and would become susceptible, I think, to addictive behaviors on an app where you really should be just thinking about the future. So let's move on to question number 3. Why is private credit so bad for retail investors? Honestly, it sounds like to me that hedge funds and institutional people like yourself don't want everyone else to have the same access to opportunity that you have as far as investing goes. That's a good one. Comes right for the throat, I think, a little bit there. I couldn't disagree more. I would love it if all investors, all traders, retail or institutional, accredited or not, had access to all the products that were offered. The reality of the situation is not everyone has the know how or the knowledge to invest in certain products that are very, very complicated financial products. We should somehow develop a way for the ordinary person to somehow transact in those marketplaces if they've taken the time to understand and know how it works. That would be great in a perfect world. However, that's just not how things work. And the reality of the situation is there's a lot of bad players in the private equity and private credit world. Not everyone, but I'm just saying there are a lot of bad players that are predatory. And that's why institutions get paid a lot of money in fees to manage money, is because when they invest in products like this, they're either creating their own fund to invest clients' money in, or when they're investing in someone else's fund, they've done the due diligence required. Like, you have to remember, these funds pay people millions and millions and millions of dollars to do due diligence and understand truly what they're investing their clients' money in. For some random like myself off the street, I'm not a random off the street anymore. I've been doing this for a few years. But prior to me having this job, if you said to me, oh my gosh, there's this private credit fund that has a targeted 15% yield, I'd be like, oh my gosh, that's awesome. 15% yield. That's way more than I could get if I invested in an ordinary bond ETF, for example. That's very attractive, but you're not understanding the risks that come with that, the illiquidity, the redemptions. There's a lot of things that go into these deals. Sometimes they market a deal as X, Y, and Z, but X, Y, and Z is a very, very small percentage of that deal. And it's a little bit of a marketing scheme. And then it's filled with a lot of other riskier investments. So I don't have a whole lot more to say on that topic. In a perfect world, I would love it if everyone could invest in every product that was offered. But I think the fact of the matter is there are ways to get exposed to private credit and private equity through investing in different publicly traded vehicles. There are some ways to do it. It's not super common, but there are ways to do it. And frankly, I think that's the better option anyway, because if you're a retail investor and you end up needing your money for something in the short term and you don't make a whole lot of money, I think that's a better option than having it locked away. And if you have an event where you were lied to and the credit in some fund starts to go bad, some companies start to default, and you want your money back as soon as you can get it, and the fund tells you you can only have 5% of your cash back, the rest is going to come later, that could put you in a really tough situation if you need the money on hand quickly. Let's move on to question number 4. You brought up possible synergies between Disney and OpenAI's Sora product on a past podcast. What do you make of the news they are killing that business and Disney is scaling back that partnership? I don't really know what to make of it. I don't have much to say on the Disney and OpenAI front, really. I'm trying to remember. I do remember that podcast where we spoke about it. I'm just trying to remember the details of the deal. What was Disney getting in return? I think it was some sort of warrant deal where Disney had or maybe a right deal. They had the right to buy equity in OpenAI at some predetermined price. I can't remember exactly what it was, but I do remember talking about the synergies and Sora being an interesting product for Disney to have access to should they become an investor in OpenAI. Obviously, Disney creates a lot of animated film through Pixar. And so having access to Sora is, I think what I said on that podcast, would be quite interesting for Disney. There's no doubt in my mind that with Sora no longer being a product, Disney will still find ways to incorporate AI or other Sora-like products into their business. So I don't think it's really detrimental to Disney whatsoever. I don't even think they really gave OpenAI any money yet. I might be wrong about that, but I don't think that they have. So I don't think there was any downside for them in Sora no longer being a thing. But I think bigger picture, stepping back away from Disney, let's look at the market for a second. You have the poster child of AI, which is OpenAI, Sam Altman, narrowing their product lines. As a company who is supposedly supposed to be the next big thing, is supposed to IPO at this insane valuation, the last thing I want to hear about is them narrowing their product line and starting to be, I think the word people are using is parsimonious with their money. That to me, it's not something that people are going to be like, oh my gosh, throw out all of our AI investments. OpenAI is killing one of their products. It's not one of those moments, but for me, it's like not really a yellow light yet, but the green light is stale and it's about to turn yellow. Why would the biggest AI poster child of this entire AI renaissance, so to speak, be narrowing its product line if they weren't having trouble with growth and competing with other businesses in their line of work. Just think about it. If I'm OpenAI and I'm competing with the likes of Gemini and Claude and Perplexity, and you see that Claude is now surpassing me in daily active users and is now making more money per month top line than I am, and I'm like, shoot, I need to really hone in what we're offering. We're going to eliminate Sora and make sure that the other products like Codex and ChatGPT are really, really perfect and we nail it. That's a company that is showing a little bit of nervousness. And so, while I don't have much to say on the Disney front and what Sora getting killed means for Disney, I do think Sora getting killed is a little bit of an eyebrow raiser for me when I look at OpenAI as a company. Now, I was going to say, let's move on to question number five. I don't have a question number five. I usually do 5 questions on these. So I'm going to talk a little bit about a trade that I had on, and I had a favorable outcome. And it wasn't favorable in the way that you would think. It was actually something I took off when I was break even because the thesis of my idea sort of changed. And I think this is important to discuss. So when the war started and oil, I think I was specifically looking at USO, which is the US oil ETF, ripped to, I think a few days after the war, it was 125. I started to look for a product that would offer me exposure to short oil. Now, my thinking behind this was I didn't put it on right away, but after a few days, I started to think about all the issues that the Trump administration is going to have on their hands if this war doesn't come to a close soon. And my guess was if they find an off ramp within a few days, you'll probably see oil come back into 80, somewhere between 80 and 90. And if I was short oil at roughly 115, there'd be a decent trade to have there. The war is still ongoing. There's still bombs being dropped in the Middle East. It doesn't seem like we're very close to any sort of off ramp whatsoever. And to save you a bit of a story, I ended up taking off the trade on Monday when Trump said that talks were taking place and that there was potentially going to be a ceasefire, and oil dropped to just below 110. I want to say it was like 108, and my trade flipped, break even for a second, and I was like, this is a good chance for me to get out and not have this exposure anymore. Now, when I started off the trade, I thought this was going to be a very, very short occurrence and that this war was going to be over within a few days. There was going to be new leadership in Iran, and things would be sort of back to normal. I never for 1 second thought oil was going to come back to $60 a barrel, but I did think it would come back in significantly. Now, the fact that this war has been dragged out much longer than I anticipated, and it doesn't seem like Trump and the administration is caring, or maybe not caring is the right word, but isn't worried a whole lot about how this is impacting American constituents at this moment in time. Given what I stood to lose if oil somehow goes to 180, like United Airlines, I think said, or some cruise line, it was either an airline or a cruise line that was estimating that oil could be $180 a barrel in 2027. If that happens, obviously my short gets blown up. Now, so the downside is pretty drastic. And the upside was if I'm short oil at roughly 115, and I think that the price target in my head is sort of it'll go to between 80 and 90. That's sort of where my upside is capped. I don't think you're going to see a return, oil prices return to where they were prior to the war, because there's always going to be this geopolitical risk premium priced in now with everything going on in the Middle East. So the risk to reward asymmetry didn't really make a whole lot of sense. And the amount of time it was going to take for the event to play out didn't make a whole lot of sense to me. So when I saw my opportunity to get out of the trade break even, I did. And that sort of goes against what we've talked about on this podcast many times. Have your risk amount and then have your profit taking amount, and don't do anything until it hits one of those stops. This was different. The thesis changed for me halfway through. I no longer thought that this was going to be a quick thing. I probably would have had to sit in the trade for a lot longer. Do I think oil is going to stay elevated at these levels forever? No, eventually I was going to be right. Eventually, at some point in the next year or 2 years, oil is going to come back down. This war in the Middle East is not going to last forever, but I don't know how long it's going to be. And I personally don't want that exposure for that long if this ends up being a forever war. Some people have called the last one when the US was involved in Iraq. So anyway, I feel a little bit silly telling you about a trade where basically nothing happened for me, but I thought that there was a little interesting nugget there for people to take away, that when your thesis changes, you don't have to wait to get stopped out. I didn't really feel the need to wait to get stopped out and lose a bunch of money. The thesis changed. I saw my opening to get out, break even, not lose anything, and I took it. Absolutely nothing wrong with that, I don't think. If the idea is no longer a good one, There's no reason to wait for the stop out. And I think that's just sort of the bottom line point that I'm trying to make here. So, with that, we are now at the close of this podcast episode. Thank you so much for sitting there and listening to me talk about all of these amazing topics. Thank you for all of your questions and the comments and the likes on all the platforms. Keep on following us on Instagram, YouTube, and TikTok. Stay safe out there. Always have a stop. I hope you have a phenomenal weekend. Take care, and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.